Wow, we're 6.4. Consideration of the June 30th, 2025 report of Lake County pooled investments, and B, consideration of the September 30th, 2025 report of Lake County pooled investments, Treasurer Tax Collector Patrick Sullivan.
Thank you, Mr. Chair. Patrick Sullivan, County Treasurer Tax Collector, and I'm here with Carlos Oblitas from Chandler Asset Management. So we're going to go through a presentation of the quarterly report ending September 30th of this year. We're also going to touch on the June report as well, just to give some highlights there, but we'll be focused on this one. And I'll go ahead and share my screen, and then if Mr. Oblitas would like to lead off here.
Let's start on pages 14 and 15.
All right.
I think we're sharing a mic.
Or, yeah.
No? Okay, sounds good. Supervisors, good morning. I'd like to report to you on the results of your County Treasury's investment portfolio. The news are all around good. There have been some changes in the economy that I want to discuss, and I'm certain that you may have questions about it, and I'm happy to address some of those. But to start with, I'd just like to start with the statement of compliance on the report, pages 14 and then also 15. You can see that everything is in compliance with California Government Code and the county's investment policy. This is an important part of your investment program. As you are all aware, some of you intimately, that your investments are governed by California Government Code. There are several restrictions on what you can do in those investments. Everything, I'm happy to report, everything is within compliance and within all tolerable limits that are allowed in your investment policy. If we go to page number 16, this is a consolidation of the entire pool's treasury, the entire investment program. It's currently valued as of September 30th at $465.5, a little bit over $465.5 million. That comprises three components. One of those components has been wound down, and I'll explain that in just a moment. The yield to maturity as of September 30th was 4.31%. If you remember my analogy, a yield to maturity is the way that the portfolio is currently structured, what you are expected to earn into the future on an annualized basis. So the annual number in terms of income coming into the portfolio into the future, the way that you're structured right now. Obviously, when there are maturities of bonds in that portfolio, that money comes back to you and it gets reinvested. That reinvestment is done at a yield that's available in the market. Obviously, whatever the market provides, that moves your average yield up or down. Currently, it's been moving downward, and that's, well, actually, in the last 3 months, it moved upward just slightly, but it's expected that should start coming downwards because market yields have been lower, and I can explain all of that in just a moment. Very high credit quality. AA plus, which is considered very high. It's a very well-diversified portfolio. If we go to page number 17, you are lending money. Remember that these are bonds. The securities in this portfolio are bond investments, they're fixed income investments. For those of you that are not familiar with bonds, it's a loan. You're effectively lending money out and you collect interest on that money. You're collecting rent for lending that money out. And then of course, the promise of that future cash flow coming to you can be sold, so it has a value, and that value can go up and down in the market based on what other alternative cash flows are out there, whatever their alternative investments may be had. You're lending to the U.S. Treasury, to the United States government. Approximately 27 and 3/4, almost 28% of the portfolio is in U.S. Treasury securities. Those are considered the safest of investments, and a hallmark, a pillar of a portfolio that's designed for safety and liquidity, as yours is. If you remember, your objectives under California Government Code are safety first, followed by liquidity. The money has to be available when you need it. And then after those two objectives are met, then you pursue a return. And that return comes in the form of interest income. And as I mentioned earlier, the fair value of the portfolio can move up and down. We do lend to corporate, very high credit quality corporate issuers. And you can see some of the names in this portfolio. There was a season where we had a buildup of cash. We did hold a secondary portfolio within this consolidated piece here that was maintained for very, very short cash needs. There was a one-time opportunity where we collaborated with your treasurer to set up a side portfolio to do that and capture some higher yields while that money was being reserved for short-term needs. The use of that portfolio, the the utility of that portfolio kind of went away. The reasons for having it, the advantage that you were getting, the market just sort of made them disappear. So as a result, that portfolio was allowed to age in and build up as cash, and then that was eventually folded back into the main portfolio. That's being reallocated, or has been reallocated as we speak. Some of it is still held in cash, but it's in the process of being reallocated. I'd like to flip forward to page number 21. Overall, as I mentioned, rates, we've been able to capture rates as rates were higher in the markets. You can see the history of that purchase yield that we looked at earlier. But as I stated, it's anticipated that this yield will start gradually coming down. The yields that are available to us in the markets today are lower than they were 2 months ago, 3 months ago, and a year ago, and I can show you a chart on that. But it just means that as we have maturities in the portfolio, or if we sell out of something before maturity to rebalance the portfolio, that new reinvestment is going to happen at a lower yield, and as those creep into the portfolio and replace higher yielding securities, this average yield that you see here on page 21 should start gradually coming down. Part of your strategy that you set up with your treasurer tax collector when we began working for you, part of that strategy was to pursue a longer duration position in the portfolio. And that was basically meant to stay at somewhere around 1 3/4, 1.8 years. That strategy is now of very good use to you, because it just means that we buy securities primarily between 1 and 3 years, sometimes longer, sometimes as long as 5 years, but they average 1.7, 1.8 years. Now, as yields fall, you have pieces in your portfolio that you're going to be waiting, if you hold them to maturity, you're going to be waiting upwards of 3, 4, 5 years to replace. It means that they're higher yielding securities that are going to stay in the portfolio for longer. And as rates in the markets fall, there are less maturities coming in than had you been much shorter. So in essence, this longer strategy is protecting your income right now, and it will do so for some time. If we go to the individual portfolios, the main portfolio is on page number 23. This is the main one that I'm talking about. The duration currently is 1.82 years. If you look at the middle column, second row, the duration and the weighted average maturity are very similar. The weighted average maturity just tells you on average how often things are maturing. It tells you right now they mature on average. This portfolio turns over about every 2.2 years on average. As I stated, there are longer pieces, but the duration is a different number. It's a risk measure. It tells us how sensitive the market value of this portfolio is for a given interest rate shift in the markets. Shifts in interest rates in the markets move around your market value. 1.82 years means that there will be a 1.82 gain in fair value if rates fall 100 basis points, 1% across the board. 1.82 years means a 1.82% gain, or loss, I should say, if rates go the opposite way, if they rise. Rates and prices move inverse to one another in the bond markets. This portfolio, the current yield to maturity is 4.38. That's very strong. But if you look at the market yield, that's the yield I would get on this portfolio if I invested new money in this strategy to make it look like this portfolio as of the date of this report. Notice that that's 3.86. It infers a reinvestment rate. So you're currently earning into the future 4.38, which was higher from 3 months ago, 4.25. I'm looking at the middle row. But the market yield 3 months ago was 4.05. You can see that that's fallen. It's because market rates are much lower today than they were. It just means, what this means, the translation is, within 6 months to 9 months, you should see lower income come into this portfolio. The interest rate cycle is shifting, and the yields that are available will be lower into the future, and it just means that your income will not be as strong as it has been over the past couple of years. Let's flip over to page 25, the return on that portfolio. And we don't usually present returns, but we thought it was a worthy number to take a look at. This is how so rather than a yield to maturity, which looks forward as to what you're expected to earn in interest income only, this is a look back. It's a look back at the portfolio of how this portfolio grew for a given period of time. And that growth is coming, as measured in this number, it's a total return. That growth is coming from interest income that you actually earned and collected, Also, if anything was sold before maturity, if there was a realized gain or a loss on that sale, that is also included in here. And we also include the change in value on paper for all the securities in the portfolio. So if the interest rate shifted and it caused the portfolio to go down in value or up in value, that number is captured here as well. So it's a very holistic view of how this portfolio grew. For the past 12 months, ended September 30th, the growth was 4.32%. You grew this portfolio at 4.32. And I would tell you that a lot of that, in fact, most of that came from interest income. About, we'll call it 7/8 of this portfolio came from interest income. We have a benchmark. It measures the amount of risk that we're taking on to try and achieve these returns. Well, the return for that benchmark was only 388 for the portfolio versus your 432. For the amount of risk that you're taking on, you've beaten your performance measuring benchmark. You've done well. Over the past 2 years, that return number for the portfolio was 5.62. Which is very strong. I would say that about 2/3 of that came from interest income. Maybe 3/4 came from interest income. The rest came from fair value appreciation. And versus the benchmark of 529, again, you've done well. Since we've been working with you on this portfolio, which goes back to the weird dark days of the pandemic in 2021, 2021, we actually started investing in October of 2021. You've been averaging 2.7% per year versus the benchmark of 2.09. That encompasses a period of time when interest rates were below 1%. If you remember that, below 0.5% in part of that time period. So you've done okay. The next page, on page 26, this has the same returns, but as of your fiscal year end. We didn't get a chance to report from June in person as we normally do, but this gives you an idea of how you ended your fiscal year. Well, your fiscal year ended June 30th, so I'm just looking back at that 1-year return as of the prior June. Well, that return was 5.9. So very, very, very strong returns. I would tell you, I'm going to flip back over to, let's take a look at page number 9. What you're looking at on the right-hand side chart of page number 9 is the effective federal funds rate. If you remember, Fed funds is that overnight lending rate. It's the rate that banks charge one another for an overnight loan. Banks take loans out from one another to meet capital requirements and such, and this is generally what they end up paying each other. And this rate is set, a target for this rate is set by the Federal Reserve in the United States, and that's how they control monetary policy. In essence, the Fed sets a target for this by saying we will raise that target if we think that inflation is very high, to basically make it more expensive for banks, and it gets passed out to the bond markets and to people and personal loans and such. It basically makes it more expensive for people to borrow, and what it does is it removes money out of people's hands. They have less money to go spend, and because when they're spending money, they're competing for goods and services, and that competition can drive prices higher. That's called inflation, and too much inflation is a bad thing. So when the economy is heating up and there's money in people's pockets, they make it more expensive to borrow, cutting off access to credit by raising rates, by making it more expensive. If you think of buying a home and you have a mortgage of 5%, or let's say 6%, and now all of a sudden mortgage rates go to 6.5%, it's too expensive to afford that house because you can't afford the payment. So you might wait until rates come down. And when rates come down, maybe you jump back in. While you wait, you're not spending that money and driving those prices higher. So in this instance, the Federal Reserve, the opposite is happening. What is happening is that the economy is slowing down, and we're not generating as many jobs as we have in the past. So the Federal Reserve is doing the opposite. They want to put money in people's hands, so they spend, and that creates demand, which causes businesses to expand. They borrow. It's cheaper for them to borrow. They expand. They hire more people, and they generate more jobs. They stimulate the economy by lowering interest rates. So the Federal Reserve is in that mode right now, and they lowered rates twice, then they paused for a long time, and then they lowered rates twice again. The last meeting was at the end of October 29th. It is generally expected, it was generally expected by most investors that the Federal Reserve would lower rates once more again between now and the end of the year. There is a meeting. They meet about every 8 weeks. It's expected that they were going to lower rates again in their December meeting. The odds of that before the last October meeting was like almost 100%. Because we can generate probabilities on this based on where investors buy futures contracts on these things. It's complicated, but basically the odds were close to 100%. Those odds are less than 50% today, and that's simply because after the last meeting, the Federal Reserve released their minutes as they normally do, and they gave a press release. And one of the things they said was, we see the economy still resilient, showing some strength, but job creation has moderated. We're not generating as many jobs. And not only that, but at the point that they met, the government had been shut down for close to a month. And the government releases key indicators, key data, economic data that they use to make these decisions, primarily the jobs creation number known as the non-farm payrolls, which comes out the first Friday of every month, and also inflation. Now, eventually, the government, through the Bureau of Labor Statistics, they released a CPI number, Consumer Price Index, which is an inflation number. They needed it because they had to calculate COLA adjustments for Social Security benefits. So we have that number. It came in at 3%, which was elevated. And so it means prices are still a little higher. But the jobs numbers are expected. They were already weak coming into the government shutdown. Now that we're in this government shutdown, it's over. It's the longest that we've had in history, 47 days. There's a lot of uncertainty as to what the Federal Reserve is going to do. But in essence, what we think is happening is that we're still in a little bit of a late cycle economy. If you look at the economy in the business cycle, we're sort of at late stage, which means that we're seeing weakness permeate. And there is still room for the Federal Reserve to lower rates at some point in the future. If not at the next meeting, certainly within the next 6 months of 2026. What does that mean for you? What it means is that if they lower that target rate and the markets sort of follow through, and we don't have some sort of inflationary effect coming through all of this, you should see reinvestments coming in at lower rates. It means that earnings, though strong and historically strong from what you've seen over the last 15 years, they just won't be as robust as they have been in the past year. The opposite side of all of this, the bright side of all of this, of course, is that when rates fall, the value of your existing investments actually go up. Sometimes that gets realized when we reposition, sometimes it doesn't, but we do book that, as I just showed you, in the total return number, so that's a good thing. And certainly your auditor controller will book that in the annual consolidated financial statements that you, or report that you issue every year. That'll get booked in your earnings. So from a financial position, you're in very good shape. From a safety and liquidity position, this investment program is in very good shape. Your treasurer takes steps to make sure that the approaches are very well diversified through using our management services in this portfolio, through utilizing local government investment pools that are available to him and his staff, and to making sure all the time that money is available when needed and optimized as much as possible. I'll stop there and take any questions you may have.
Supervisor Pysker?
Well, I always love it when you come to visit, Carlos. We learn so much. And our portfolio is, it's just one of the things I think we're all most proud of right now. We knew it was going to peak out at some point, and I think we're right about in the time that we thought that was going to happen, and right about at the amount that we thought that it was going to happen. And so looking forward, I know it's really hard given everything you just told us, but what should we expect for budgeting and planning for the next year? Like how significant do you think falls will be?
The impact for next year, for next fiscal year, shouldn't be significant,
okay,
but it will be lower. It goes back to a statement that I made earlier, which is that because you have a longer duration strategy, your strategy is to stay in the range of somewhere around 1.7, 1.8 years, regardless of what investments you're doing. Logically, you would want to get as long as possible when rates are falling and as short as possible when rates are rising. Logically, if you think about it, if I'm shorter on average, I have more maturities coming in, which I can then redeploy faster in increasingly higher rates as rates rise, and the opposite when rates are falling. If rates are falling, I want to get as long as possible. That means that I have less money coming due, which they hang on to their yield for a longer period of time, and I'm not forced to reinvest in lower rates available in the markets as rates fall. But of course, getting super long, super short, how do you make that determination? When do you do that? And at what point do you get in? And what point do you get out? And how long will rates be moving? No one knows that. And this is why you pick a target, you stick with it regardless of what rates are doing. Now, we do position shorter and longer within a band around that target. That target is protecting your income for next year. Only a small portion of this portfolio will be replaced with those lower yields between now and the end of the fiscal year. So only a portion of the portfolio, not the entire program. So if you hear that Fed funds target rate is somewhere around 3.75% to 4%, which is what they're targeting, and your portfolio, you're reinvesting in somewhere around 3.8 or something like that, those reinvestments only impacts a portion of the portfolio. So it will take some time. And the reason it will take some time is because you implemented this strategy of being longer, which frankly is protecting you at the moment. I think that the impact will be harder felt possibly in the not this next fiscal year, but the following fiscal year. But who knows what rates may look like at that time.
Okay, that's good to know. Thank you.
Yeah, I might be able to add something to that if it helps. We did have this chart that I was going to go over, and this is just we've been putting up each time. It's the quarterly earnings for the county, because I think partially in answer to Supervisor Pyska's question, the rate that you were seeing in the report from Chandler, that's based on accruals that are coming in and money that we're earning that we actually haven't realized yet, because bond payments come every 6 months, let's say. So this is the actual cash flow into the county. Into the treasury. This is when the cash actually hits us, and this is what we're seeing. So these are the numbers that are essentially plugged into the budget. And so what I guess I would point out is that, yeah, we're definitely hitting the peak here. If you see, this last quarter, we brought in a little over $6 million. I would expect, based off what we're seeing, that this is either the highest or next quarter could potentially be higher, but because we've been spending down our cash, that's unlikely by my estimation. So I think you're probably seeing the peak. So as you go up, I think as Carlos was stating, if we're seeing this rate drop where we're going to be reinvesting at 25 or 30 basis points lower than we've been, then really you're going to see numbers more like where they were in here, I think, in the next fiscal year. After that, if it stabilizes, if the Fed doesn't keep cutting rates, we may basically sit just below where we are. But if they keep cutting rates, then just as this chart has gone up, slowly we would see that actual cash coming in go down over the upcoming years.
Okay, thank you.
All right, I'll open it up for public comment.
No.
All right, not hearing any. Well, close public comment and bring it back to the board. Lloyd, anything? I seen you move your hand, so I thought maybe.
Thank you, Mr. Chair. So there's two recommended actions that can be taken as one motion, which is to accept the reports, the one from June 30, 2025 and September 30, 2025. That would be the
So moved.
board's motion.
Second. I have a motion and a second. All in favor?
Aye.
Any opposed? That motion carries. Thank you very much.
Thank you.
Patrick and Carlos.
Thank you.
All right.
Good to see you.